Alrighty, welcome everyone. Welcome to the Hurley Investments as we present what is option trading. This is going to be a quick overview to give you a general idea what option trading is. We'll go over the 4 option instruments and we'll go over how you see them on a chart. But plain and simple, option trading is a derivative that will derive its value from some type of equity. I'm going to put stock in here because usually it's stock ownership. It could be an index, an ETF. There are other forms of options, but this is the most common one. In simple layman's English, to understand options in general, it's a contract that gives the purchaser or seller the right or obligation to sell or buy the underlying stock at a predetermined stock price for a predetermined period of time. To simplify that, when you buy an option, you're buying the right. So a purchaser has the right to sell or buy an underlying equity at that, again, predetermined price at a predetermined time. A seller of an option is an obligation to buy or sell the underlying equity. When you take someone's money, you're now obligated to do something. That's the way how I think about selling and buying. When you're buying, you spent the money, you have the right to do something. If you sell it, you've taken someone's money, you're now obligated to do something. Although options are most often used with stock ownership, you can do a version of options by themselves, or sometimes 2 options together or more that can create an option spread. You have to remember, one option contract controls 100 shares of your underlying stock or equity. If we go over the call option, probably the most common position. Again, it is a derivative. Its price will be made up based on certain characteristics of a stock price, most likely. Its purpose is to buy that stock at a cheaper price than it will be trading somewhere in the future. The right associated with it, it's a contract that gives the purchaser the right to buy the underlying stock at a predetermined price for a predetermined period of time. These calls will increase in value as the stock price goes up. In other words, it's a bullish position to own or a bullish options instrument. Don't forget, one call option controls 100 shares of stock. So if you wanted to buy 500 shares of something like Apple at $225 a share, it's going to be 500 times that $225. If you want 500 shares, you'd have 500 contracts. And just to give you a general idea, that would be about a $112,500 investment. This long call position, when you're purchasing a call, it's most commonly referred to as stock market lingo as a long call. And obviously, you buy it up in this position, it'll be a debit out of your account. Selling a call, still a derivative, nothing changes there. But when you sell a call, it gives the seller the obligation to sell the underlying stock at a predetermined price for a predetermined period of time. The calls increase in value as the stock price goes down. In other words, it's a bearish position. No one's going to obligate you to sell stock to them at 100 if it's trading down at 80. Again, one call option controls 100 shares of underlying stock. If you wanted to sell 500 shares of your Apple stock, you would need 5 contracts to do so. This sometimes can be referred as a short call. Most commonly, it's actually called a short call. It sometimes can be a naked call. A naked call is that there is no stock ownership involved, and that particular call has unlimited risk. For that reason, sometimes options get a bad rap, it's so risky. But in real life, as long as you don't run this option, the short call without stock ownership, options are usually more protection and much cheaper, a lot less risk involved with the position. Obviously, you sell up in this position, which means you're going to have a credit into your account. You're going to take someone's money. and that's your short call option. A put option, same as all the others, it's derived from the stock price. This purpose is to protect the value of stock ownership from a loss. In all essence, this put option acts like stock insurance. It's similar to purchasing a car insurance to protect the car from loss or damage. This is one that you pay a premium, and you're going to have the right to sell your stock at a certain price for a certain period of time. For example, in 2008, if you had positions in play with the put option, you could have made up most, if not all, of that downward movement. The puts increase in value as the stock goes down. It's a bearish position to own in your portfolio that'll make you money. It's very often used with stock ownership, but you can purchase it by itself. Again, one put option will control 100 shares of your underlying stock. So if you have 500 shares, you will need 5 contracts. This particular position in lingo, Wall Street lingo, is a long put. Obviously, long equals you're buying, you're purchasing it. And sometimes it's called a protective put when it's used on stock ownership, but we'll go over that later. Selling a put, as always, it's still a derivative, but this contract gives the seller the obligation to have to buy someone's stock at a certain price for a certain period of time. In this particular position, the puts increase or you keep your credit as the stock price goes up. It's a bull's position to own, meaning that if the stock goes up to 120, no one's going to obligate you to buy their stock from them at 100. It'll just expire worthless and you'll keep your credit. This can be called a short put or a naked put, but it does not run unlimited risk. You sell to open the position, you take a credit in your trading account, and you hope it expires worthless. So how does this work in real life? You need to have a brokerage account with margin. That usually most accounts will offer you an opportunity to trade options, even IRA or Roth accounts, trust accounts, business accounts, individual accounts, they all work. You're going to select from a list of dates that options expire and a list of strike prices, the price you want to be obligated or have the right to buy or sell a stock from. This is called an options chain. I'm going to show you a picture of it here in just a quick minute. The strike price is that, again, that price you want to buy or sell that stock at some time in the future. And it's going to be different than an option price, which is what you pay to own the option contract. Just meaning, if you take a quick peek, we have Apple up here in the left-hand corner. On the left-hand side, on the right-hand side, you have puts. On the left-hand side, you have calls. I'm going to go ahead and I'm going to use a highlighter. Here are your puts. Here are your calls. When you choose to use these options is up here on the top. We have check mark looking at the November option chain. Right below it is probably the January 2020. Let's use the puts. Everyone uses the calls. I'm sure you can find a bunch of videos on that. Let's use the put side. If we were looking at purchasing a put, we need to pick the month. We're going to choose November, as you see my red arrow there. And we're going to go to the strike price. We're going to find the strike price that we want to choose to use. Right now, this particular screenshot, if you look up here in the upper left-hand corner, the stock is trading at roughly $225. Go Apple, right? With that said, you're going to choose a strike price. For me, I'd probably choose a 225 if I was going to protect my stock by that long put. The protective put is insurance. I would pick the option, the ask or bid column. I'm going to go over that in a minute, but if you're going to buy an option, you always buy it at the ask price. If you're going to sell an option, you sell at the bid. For $9.40, I can choose to buy the right to protect Apple, to have the right to sell it at $225 between now and November 19th. Today we're at the beginning of October, so I've got about 5-6 weeks for a cost of $9 or roughly, 3.25%, 3.5% here. I could have the right to sell Apple at $225. I can choose anyone in between them, but I'm choosing the 225 because it's at the money and it will be my best bang for the buck. So if I was going to buy an option, I'm going to buy at the ask price. If I sell it, it's the bid. If I was going to buy that long put, again, I'm going to go to the ask price column. I'm going to sell to close it if I need to make a profit on it at the bid ask column. We're purchasing a long option because it gives us the right to sell our stock at the stock price I'm going to choose. On this particular day, I'm going to choose 225. It's right about where the stock is trading at, so I can protect myself now for the next 6 weeks to get me through a volatile October, to get me through some economic events that are coming up, and to also get me through an earnings event on Apple. If I was going to short a put where I wanted the obligation to buy the stock at a certain price, I'm going to sell to open that option at the bid price. I'm going to buy to close it at the ask price. It's just reversed from the long option. This is a short option. That S in short stands for selling. Remember, we're selling a short put option that obligates us to buy the stock at the stock price we choose. As we're talking about Apple, I may sell something at like 220. I'd say, hey, I'm willing to buy Apple at 220 when it's trading at 225, right? Hey, I want to buy it cheaper. If I was to choose that price, someone would pay me $7.10. Pretty neat if Apple goes down to 220 to get to pick up Apple at 220 and someone pays me $7.10. It'd be like owning the shares of stock at $212.90. I get to keep that credit, right? Pretty neat. I love options because it gives you the option, pun intended, to do a bunch of different things. Those are the 4 basic option instruments and how to trade options. If you have any questions, please come give us a call. You can reach us at the toll-free number down below. You can always see a lot of what we're putting out on myhurleyinvestment.com. If you have particular questions, go ahead and email us at support@hurleyinvestments.com. That also means you can like this video on YouTube or subscribe, and of course ring that bell so you'll hear when we have new videos come out. Really, this is just real world investing from real investors to help people like you make some real money in today's stock market. Hope this is helpful for you. Look for more videos coming out. Have a great day, everyone.